or DAA in short. Before we dive into the very insightful session today, I just wanted to share that the DAA has set up a tokenization RWA subcommittee. Right, this is chaired by Danny Chong, the CEO of Trenches, as well as Henry Chang, the CEO of DGFT. Right, so we are doing a members call. So if you are keen to find out, latest developments, discuss trending issues in tokenization as well as RWA, please approach us, and then we'll get you in touch with the subcom chairs. Right. I think my DAA colleague Lionel here can also assist with connecting, right? The DAA is also organizing our flagship Digital Asset Summit on the 6th of October this year, and this is right before Token 2049. Last year, we attracted more than 350 attendees from 21 countries, 180 companies, and this includes like MAS, the US, SDC as well. So that summit actually provided very good insights into regulatory developments as well as other developments in tokenization, technology, cybersecurity as well. This year we're expecting a larger crowd, so we are engaging with like speakers, sponsors earlier as well. So if you are keen, please do approach us early, and then we can get that conversation started. All right, we'll get into the session proper. So we often hear that tokenization is transforming global finance. But really, we should ask ourselves, what needs to change for that transformation to happen, right? Because tokenization isn't just about putting assets on the blockchain. It actually challenges how traditional markets are structured. How do we build trust? And what does it mean for financial institutions, for private wealth investors, for fiduciaries in this region? And today, I think we have the privilege of inviting subject matter experts from SDAX as well as RHT Law Asia to share with us how tokenization is transitioning from a concept to real, scalable, and compliant implementation. What that means for all of us. First, I would like to introduce Sunil Mascarenhas, from the CEO of SDAX. The SDAX is a digital asset exchange, and they trade asset-backed digital securities. They are also licensed by the MAS. Sunil has more than 30 years in global financial services. He's worked for major FIs such as Barclays, Morgan Stanley, Deutsche Bank, and ANZ. He has also led risk and governance and product initiatives across multiple markets. So if you could join me to welcome Sunil for his first session.
Okay.
Trying to see if you can hear me without mic. Yeah. If yes, just say okay. Okay. I've got a lot of words to put. Thank you, Ching, for the kind introduction. Look, as I was just getting here, I happened to look at some of the attendees at the session today. Immediately realized that there is a very eclectic bunch of people in the room who, whether they're technology or finance or legal or industry, know probably a lot more in this space. But we're here to share. I think my perspective is, as Ching said just now, as someone coming from a traditional finance world to this new world of real world asset tokenization, blockchain, and all of that was an interesting journey, an interesting experience. I can share some insights on the industry more broadly, where we see it going. What are the key tenets that make this a business that people, corporates, institutional investors, people who want to list with us, what are they looking for? And then, of course, at any point subsequent after the meetings, we're certainly going to cover the regulatory governance piece, and then we'll open up questions that you might have at the end. But I think I wanted to start with a projection that, again, I read very recently, so the policy is slightly out of date, but broadly would be consistent. So this is Boston Consulting Group. So BCG, many of you probably know one consultant similar to this. BCG is big in this space, particularly in the US. So they predicted recently that the global market for tokenized assets, so just I want to quote unquote, all of tokenized assets, not just the RWA piece that we're looking at here, could exceed $16 trillion by 2030. So to put that into some perspective, where we are today on real-world asset tokenization globally, RWA tokenization, the number I was given was about 30 billion today on RWA. Now let's not forget that all of tokenization is a much bigger subset, so we're talking a small piece of the pie. But I think it gives you some perspective on how big this market is. And it's really, for most geographies, reasonably, relatively new, virgin, developing is probably the right word. A quote that may resonate with many of you is one that this year Robin Hood made, last year, he was talking about. He says the tokenization of real-world assets is an unstoppable freight train which is coming to major markets. So effectively, you either join the bandwagon or you get hit by it. So I think what we're seeing is we're very much at that crossroads now where we need to either come on board and live with this new reality. We're seeing it all over, and we'll talk with examples. Chang and I were sharing some recent examples of where we're seeing commercial real estate tokenization as well happening, and I'll talk about that. But it is true. I mean, that is the reality of where the space is. So when tokenization, that's coming to the first slide, when tokenization first entered the conversation around capital markets, much of the discussion was centered around technology. And there again, the focus was on blockchain architecture, token standards, and the promise of decentralized infrastructure. That phase was necessary. But every new market, infrastructure begins with experimentation. Okay? But the conversation then moves on. So we moved on now. So today, tokenization is no longer being primarily evaluated by technologists. And many of those who are technologists in the room will probably agree, and those who are non-technologists, and by this I mean investment committees, I mean risk committees, I mean compliance officers, I mean trustees, I mean regulators. That's the conversation top of their mind as well. So this is the discussion where we move along. And the questions they're asking are very different. So this set of questions, the boundaries are a bit different. So they're not asking whether an asset can be tokenized or not. Their questions are probably more along the lines, how can this be governed? How can this be supervised? We were just talking earlier before we started. How can it be administered to institutional standards over time? So in other words, the defining question for this next phase of tokenization is not technological feasibility, but it is institutional credibility. Okay, that's what's going to define this space going forward. So when I speak about institution-ready tokenization, we're not referring to a particular blockchain protocol, nor am I referring to a particular technology stack. What we're talking about is something much more fundamental. We're talking about an operating model that institutions can trust. One built on enforceable legal rights, transparent governance, clear reporting, and robust investment protection or investor protection. Technologists may still change the rails on which this market operates, but the principles that sustain trust in those markets remain exactly the same. So against that backdrop, it is useful to consider where tokenization is actually gaining traction today, right? And why certain asset classes are proving to be more compatible with institutional adaptation than others. So the first category, where there is genuine institutional readiness, is private credit and other short duration yield instruments. This should not surprise anybody. You had this conversation, Henry, before. Private credit has always been an asset class that's grounded in clarity. Investors understand the economics. Cash flows are defined, and covenants are documented. So performance can also be monitored with a great degree of precision. What tokenization changes is not the underwriting discipline. That remains exactly the same. What it changes is the efficiency with which these instruments can be issued, allocated, administered, and reported. So by digitizing the representation of ownership and by embedding operational workflows into the infrastructure, tokenization can significantly improve how these instruments are distributed and managed. Smaller denominations become feasible now. So the concept of fractionalization, so we can actually get to smaller denominations. The allocation process therefore becomes a lot more efficient. Investor onboarding can now be handled with a much higher degree of precision. Reporting and any other life cycle events such as interest distributions, redemptions, can be administered a lot more transparently. Oh. People can't hear me at the back, is it? Okay. So what happens is here, for institutions, these are not cosmetic improvements. These address real operational frictions that exist in private markets today. And importantly, none of these requires investors to compromise on governance or risk discipline. If anything, what tokenization has done is it's enhanced transparency and accountability and auditability across the life of the instrument. So that is why private credit has emerged as one of the earliest and the most credible use cases for tokenized real-world assets. A second category where we do see institutional readiness is in fund structures. Here, the most practical approach has not been to reinvent the fund itself, but to modernize the way that the ownership and the distribution of this is managed. So funds are already governed. Again, many of you are associated with them by well-established frameworks. Most of the funds have well-established frameworks. You've got a fund administrator, you've got valuation policies, you've got investment mandates, you've got investor protections, all well-defined, all evolved over the years. But when tokenization is introduced thoughtfully, it can function as a digital layer for unit ownership in that fund and investor servicing, while leaving the underlying governance structures intact. So in this model, what tokenization has done is it's improved operational efficiency. It allows ownership records to be maintained with greater clarity. It simplifies the transfer and the reporting process, and it can make it easier for investors to participate in, like as I said earlier, smaller denominations, particularly, as I will mention at the end, the trends that we're seeing now in the private wealth segment. But the fund itself will continue to operate within the same legal and fiduciary frameworks that institutions trust. And that's key, again, if you're a regulator, you're a supervisor, whatever, to make sure that that trust is not eroded. And that distinction becomes very important. Institutional adoption happens when technology enhances existing structures rather than attempting to replace them entirely. I'm sure the technologists here in the room will probably agree and nod that that is true. It's just how it's being raised within the current framework. It cannot drive the train directly itself. It differentiates, yes. Real estate is another example, which is again very often discussed in the tokenization space. So what is the intuitive? Real estate has intuitive appeal. It is tangible. It's widely understood. Associated with generally stable income streams. However, for real estate, again, to be truly institution ready, several structural questions will need to be addressed with absolute clarity. First, investors need to understand what rights do they hold? Conventional property is a good example of that. Are they holding beneficial interest in the asset owning vehicle? Are they participating through a security that is issued by the structured entity? Are they separately acquiring units in a managed investment structure? So these are questions that we're saying the investors are going to have to think before they invest in a vehicle like that. Governance and control must be clearly defined. Investors need to understand how decisions are being made, how managers are being supervised, and what rights they possess relative to the owner of the real estate, or the trustee, or the asset operator, the trustee. So the third important element is the economic life cycle of the asset should be transparent. And that's, again, not always easy. This includes how income is distributed, how refinancing or capital expenditure is managed, and how exit events are structured. very important as we're going to see, exit events are structured. That's got to be defined. Once these elements are clearly established, tokenization can improve with efficiency, or can certainly improve the efficiency with which ownership is recorded and administered. It then facilitates fractional participation and enhanced transparency across the investor base. But again, the fundamental investment case remains unchanged. It's all still about asset quality, cash flow stability, and disciplined management. These are the key fundamental principles, the fundamental case that drives us. Technology does not substitute these fundamentals, it merely supports them once again. Another use case is precious metals. Again, this provides an illustration of how this model works in practice. Gold in particular is a naturally compatible asset class with digital market infrastructure. Why? Because the underlying asset is tangible, it's independently verifiable, and as we're all seeing now in the current events, geopolitical, it's globally recognized as a store of value. So I think that becomes another use case of real-world asset tokenization. So across many of these asset classes, whether it's private credit funds that I've talked about, funds, real estate, commodity-linked notes, what tokenization ultimately enables is a more efficient operating framework for assets that investors already understand. Most of these examples I've given you are assets that by and large the investing public knows about. They do understand the fundamentals. So at SDAX, our focus therefore has always been on applying digital market infrastructure to real-world asset classes, where structure, governance, and predictable economics are already well established. Private credit and structured instruments have been central, precisely because they offer these defined cash flows and clear legal frameworks that institutions and, as I said earlier, private wealth investors now recognize. Gold has taken the form of structured instruments, such as medium-term notes backed by gold tokens. So here tokenization is not about creating a speculative digital representation of gold. It's rather, it supports the efficient issuance, distribution, and administration of an instrument that is anchored to a well-understood underlying asset, right? So when applied across asset classes in this way, tokenization becomes less about reinventing the investment itself and more about improving how that investment is issued, distributed, and governed. So what technology does here now is it strengthens the operational layer of an investment thesis that investors already recognize and trust. So beyond these established asset classes, there is a growing interest in a broader range of real-world assets. So these include, and we've been in different panels and other forums, and we've had, talked at length about these, but these include things like intellectual property rights, trade receivables, other income-producing instruments that have historically been very difficult for investors to access. That's what the discussion is today. Many of these opportunities are promising. However, institutional adaptation in these areas will always tend to follow a very predictable sequence. Institutions will first look for verification of your cash flows. Again, the piece about enforceable legal rights over these cash flows, robust reporting and monitoring frameworks, and then they want to be confident that the asset can be managed and consistently administered over time. Once these conditions are met, institutions become far more comfortable allocating capital to these new asset classes. And you can see things like IP and all that is still emerging, but not in Asia, not as yet advanced, but we're seeing in the US, particularly in the music industry, how that is really evolving now. So all these big artists are selling their rights to music records, labels, etc. So that is an area which is still relatively developing in our part of the world. So what we're saying ultimately is innovation in asset classes is welcome, but it must always be grounded, as we said. We must always make sure it's grounded in what I define as an economist as verifiable economics and definable disciplined governance. So when we step back and look across these different use cases that I've just touched on now, a pattern becomes very clear. So institutional readiness is rarely defined by the novelty of the asset or the sophistication of the technology. It is defined whether the life cycle of the asset is governed with confidence or can be governed with confidence. And across markets, we see about 5 factors that you see here that determine whether a tokenized structure is institution ready. Enforceable rights, I don't want to dwell on all because I've covered these in the point, but certainly your investors must have clear claims linked to the underlying asset. They cannot just, the tokenization cannot just represent symbolic ownership. It's got to be actual ownership. It must be legally defensible. And that's what we have to make sure when we do our due diligence, that's key. The governance, etc. The governance of the life cycle governance I've talked about, right from issuance to reporting, distribution, exit strategies, well-administered assets through well-defined processes that both the investor and the regulator understands, because there'll always be a constructive dialogue we have. These, just talking to an ex-regulator here, these are emerging areas even for regulators all over the world. This is not an area they know. They are proactively engaging with players in this space, and we're going through this journey together. Some countries are a little more advanced in this space geographically because they push the agenda a lot further, but everybody's either catching up or doing our own things in that space. But the key thing is that dialogue is very important for us. Third point is controlled participation. So what we mean here is onboarding, eligibility of investors, transfer mechanisms, all aligning to suitability requirements. Many of these have specific requirements in terms of what sort of investors are allowed, so all of that needs to be monitored. The fourth is safeguarding and custody. That's always important. Assets have to be protected, they've got to be ring-fenced, there's got to be credible custodial arrangements, segregation of responsibilities, and again, a very verifiable reconciliation process over all of this. And the last one is operational continuity. Structures that can function reliably through the full life cycle of the asset. And that includes periods of market stress, what we're seeing right now, operational exceptions, one-off events that happen. So in those periods as well, we need to be thinking of how and investors protected, how that instrument's valued. It all goes into the thought process and the due diligence. So what technology does for us here is it enables these processes to be managed more efficiently, but the responsibility for the governance will still rest with the institutions that are operating in this market. And I see some of my peers here, and I'm sure all of them would agree that that is absolutely right. Ultimately, that ownership is with the organization that operates in this market or the institution. So from our perspective, what we are observing across Asia, if I may speak, and that combines with some of the views of the other speakers who are going to be talking to you, is the following. It's not Asia I'm talking for, is not a rush towards tokenization for its own sake, or because we're following the drumbeat that's set by another part of the world. What we are seeing is a very gradual but deliberate shift towards a more precise and structured form of capital formation. Investors, particularly institutional and private wealth, as I was talking about, participants, are seeking opportunities that provide two things really, yield and diversification. But they're equally focused on clarity. What do I mean by clarity here? Clarity on structure, clarity on rights, clarity on reporting, and clarity on how, as I was just saying earlier, downside scenarios are managed. What are issuers looking for? So this is the investor. Issuers, meanwhile, are beginning to recognize that tokenization now provides a more efficient way for them to reach out to investors. It providing that the structure is credible and governance standards are robust. In this environment, platforms such as SDAX play a role that is less about promoting technology, but more about ensuring discipline. Our focus has always been on building a regulated marketplace where tokenized real-world assets can be issued, distributed, and managed within the framework that investors also recognize and trust. So that means for us, aligning our digital infrastructure with the same expectations that I've said govern traditional capital markets, which is what I said when I opened my game for. That's what they're looking for, the best of breed, best of both worlds. So that's transparency disclosures, documentation, eligibility, and ongoing reporting. So technology is simply the infrastructure that enables these markets to operate more efficiently. So finally, I just talked about, and I threw out that concept out there earlier in my conversation about private wealth participation. So for those who may be familiar with that space, it is worth talking, because this is one of the areas, where tokenization will gradually expand access to private markets. So what private wealth investors, they do not want to adapt new instruments or to new structures because they're novel. They adapt because they want to understand the structure, they want to monitor, and they want something that's monitorable, and it's aligned with fiduciary responsibilities. For private wealth distribution to work, several conditions here must be satisfied. The opportunity must be able to be explained in a very straightforward economic terms. It must be reportable within the portfolio. Again, liquidity events, liquidity expectations must be communicated honestly. And suitability frameworks, because as all of you know, suitability is a key aspect of private wealth participation. So suitability frameworks to ensure that these products that are being sold to their end clients are appropriate for the investors. So tokenization can assist in this process by enabling smaller denominations and improving the transparency. So I talked about the concept of fractionalization earlier. So as with institutional markets, however, there's one common point though. I may talk about private markets as being, or private wealth as being a new segment, but as with institutional markets, trust ultimately comes from governance and disclosure rather than the technology role. So I will close, mindful of time. I will close with one final observation. So for many years, the narrative around tokenization has been framed in terms of disruption. Many of you here in this room will know, whether you're a bank, you always thought this tokenized asset space is going to be the next big disruptor out there. This is years ago. Every bank has been working on scenarios where how do they tackle this industry around tokenized assets, because at that point, less regulation compared to a bank which is highly regulated. So disruption has been the key operative word. The idea that new technologies would fundamentally replace existing financial infrastructure is a concern. But what we're actually seeing in practice today is something much more measured and much more durable. Okay, tokenization is not replacing capital markets. Okay, there will always be a space for both. What it is doing is it's gradually modernizing how these capital markets operate. And that's where the blockchain, that's where all the technologies come in. The speed, the efficiencies. That's what it's actually doing. That's what this tokenization space is doing. So where implemented responsibly, it makes your markets more efficient, it improves your transparency and access, as I said earlier, to a wider range of investors. But in my view, the institutions that have succeeded in this space will not be the ones that tokenize assets the fastest. They will be the ones that maintain the highest standards of governance, discipline, and trust as these new infrastructures scale. Because in one line, in one sentence, ultimately in private markets, trust always scales before volume does. Okay, that is a fundamental driver. And that is ultimately what will determine how this industry evolves in the years ahead. So I think with that, thank you. I'll stop here. And just for many of you who probably remember decimalization, when that whole concept of decimalization started, I see many nods in the room. There are some who don't know. But another quote, I'll just end up because I love these quotes, and they're very relative, very, very contextually important. It was CEO of a US firm called Beacon Advisors who said, tokenization is the new decimalization. So it's just saying again to the earlier point I made about that freight train, this is again saying we're at the crossroads, guys, so we've got to get it right. Because the future, not just for us, but for generations to come, is going to be built on this. So I end with that. Thank you. Yes.
Okay, so hello, It's a pleasure to be co-hosting this event with Digital Assets Association. Thank you, Ching. I'm speaking on this and the next session, hence I've combined my presentation into one. Tokenization has rapidly moved from experimental blockchain projects to institutional financial market initiatives, and now further on to real-world asset tokenization. Today's discussion will focus on two key questions. First, how legal and regulatory frameworks enable such markets while managing risks, and second, how governance and accountability structures form the trust layer that's required for institutional adoption. Just to get the definition out of the way, asset tokenization refers to the process of representing ownership rights in real-world assets, whether physical or financial, in the form of digital tokens recorded on a distributed ledger. So in essence, the blockchain becomes the infrastructure through which ownership and transactions are recorded and verified. These tokens represent assets that have value, that have ownership rights or utility, and the blockchain provides a secure and transparent way of recording these rights. Tokenization has the potential to transform capital markets in the various ways set out here. However, these innovations also raise important legal and regulatory questions, particularly around ownership, custody, settlement finality, and regulatory oversight, which we will explore in the next sections. When we look at tokenized markets from a legal perspective, regulators essentially are trying to balance two competing objectives. On the one hand, they want to enable innovation. Technologies such as DLT have the potential to really transform our financial markets, make it more efficient, reduce settlement friction, expand access to investment opportunities. But at the same time, regulators must continue to protect investors, maintain financial stability, and preserve market integrity. So these are the core objectives that underpin traditional financial and securities regulation. Alongside the regulatory perspective though, there's also the private law or the market perspective. For markets to function, investors and participants must have certainty around fundamental legal questions like who owns the asset, whether transactions are legally enforceable, and so on. So ultimately, tokenized markets can only scale if the two perspectives, regulatory and private law, are properly aligned. This slide here illustrates the broader ecosystem that supports tokenized financial markets. One important takeaway is that tokenization is not simply a technology innovation. It is an ecosystem that combines regulation, financial institutions, tech infrastructure, intermediaries, and investors. Starting at the top, we have the legal and regulatory frameworks that underpin the market. At the global level, organizations such as IOSCO set international standards for securities markets. At the private law layer, initiatives such as UNITRA aim to harmonize legal concepts across different jurisdictions. Then at the regional level, frameworks such as the EU's MICA seek to establish consistent rules for digital assets across multiple jurisdictions. And finally, national regulators such as the MAS in Singapore or the US SEC provide detailed rules on licensing and supervision. One key challenge here is regulatory fragmentation, where different jurisdictions may apply different approaches, but generally there is a pattern of harmonization in terms of recognizing legal concepts. Moving down, we have the core market participants, the issuers, the banks, the asset managers, and so on. These entities create and manage the tokenized financial products. Risks at this level include misissuance, inadequate disclosure, which is why regulation and governance frameworks remain essential. The next layer is the tokenization infrastructure, including the whole underlying technology stack, as well as the supporting systems for identity verification, compliance, and transaction processing. Governance tools, including voting systems, protocol governance, help to manage how these systems evolve. However, this layer also includes risks such as cybersecurity threats and coding errors. And this actually requires strong technical governance and audits. Below are the market intermediaries that provide the operational support, right? Your tokenization platforms, your liquidity providers, and so on. The key risks here relate to custody failures or operational breakdowns, which are typically addressed through asset segregation and prudential regulation. And finally, at the bottom are the investors themselves. They range from your traditional investors to strategic ecosystem participants and alternative capital providers. Investor protection still remains a critical concern, particularly around mis-selling or lack of understanding, which is why disclosure and suitability rules continue to play an important role. Overall, the key message of this slide is that tokenized financial markets operate within a multi-layered ecosystem where legal frameworks, tech infrastructure, financial institutions, and investors must interact effectively for the market to function well. Here we highlight the emerging global regulatory consensus on tokenized financial assets based on IOSCO's November 2025 report on the tokenization of financial assets. Interestingly, our MAS led the working group that prepared this report, well worth a read. It goes into a lot of detail that we just don't have the time to go through in this forum. IOSCO observes that tokenization is still relatively nascent, but it is expanding rapidly, particularly in the area of asset issuance. However, secondary trading for these assets remain limited, and most tokenization projects still operate within hybrid systems that combine blockchain technology with traditional financial market infrastructures. In terms of risk, IOSCO's analysis is quite important. The report notes that most of the risks associated with tokenization are fundamentally not new. Okay, they largely correspond to risks that regulators already manage in traditional financial markets, your market integrity, operational risk, investor protection. That said, DLT does introduce new risks and new vulnerabilities arising from, cyber attacks, failure in key management, as in key management personnel, and other technological vulnerabilities. The overall regulatory objective is therefore to enable innovation while maintaining market integrity and investor protection. And consistent with this, IOSCO supports a technology-neutral approach In other words, the same regulatory principles would apply, that govern traditional securities should generally apply to tokenized financial instruments. It makes sense, yeah? UNIDRA is an independent intergovernmental organization. Although the principles do not directly regulate our markets, they do provide the international legal standards for private law treatment of digital assets, encouraging jurisdictions to harmonize their legal frameworks. So, alongside regulatory guidance from securities regulators, another important development comes from the private law perspectives, reflected here in the Principles on Digital Assets and Private Law that was published in September 23. The first key principle is the recognition of digital assets as objects of proprietary rights. And I think a lot of the recent court cases in Singapore and around the world have recognized that. This means that digital assets can be legally owned, transferred, even used as collateral. Establishing this form of legal recognition is essential because financial markets ultimately depend on clear and enforceable property rights. Secondly, UNIDRA introduces the concept of control as a legal concept, which serves as the functional equivalent of possession for digital assets. So in the digital context, control means really the ability to use an asset to exclude others from doing so. This actually draws from a case law, a very well-known case law from the House of Lords in the UK. Okay. So this concept of control performs a similar role as that in traditional markets. Third, the principles address custody and intermediaries. Importantly, custodians may control digital assets without becoming their legal owners, which is why those of you in the payment space might be familiar that just not too long ago, our Payment Services Act relating to digital payment token service providers have included custody as a licensable, as a regulated activity that requires a license. Fourth, the UNIDRA principles provides guidance on security interests in digital assets, enabling them to be used as collateral. And this is important, right, for the development of finance instruments. Finally, the principles aim to promote cross-border legal harmonization, providing a framework for jurisdictions to adopt or adapt. This here highlights some of the key insights from MAS's Project Guardian report on operationalizing tokenized funds. I think given the development of the market, the whole sector, tokenized funds is something really worth looking at, and I think the report is also a good read. So firstly, the report highlights the importance of clear legal frameworks linking digital tokens to investor ownership. The MAS there identified 3 operational models: the digital mirror model, where the blockchain mirrors the traditional shareholder register; the digital twin model, where both the blockchain and the off-chain register operate in parallel. Do go read, because it goes to a lot of technical details and the difference between mirror and twin. It does sound similar, right? And the digital native model, where the blockchain serves as the authoritative legal register. So each structure really does has implication on investor rights, regulatory compliance, and operational risk. The report also highlights the importance of on-chain settlement assets for scaling tokenized markets. So it introduces into the ecosystem our digital payment tokens like stable coins, tokenized bank deposits, and so on. The MAS also recognized that interoperability and cross-chain transfers could introduce new legal and operational risks, particularly around the settlement finality and recognition of ownership. The institutional adoption will depend very much on robust operational infrastructure. I think this goes very much without saying. The MAS guide on the tokenization of cap markets products, November 2025, is a new iteration of its previous guide to digital token offerings. Okay, so I think the points here are quite self-explanatory, consistent with what we know about our regulator and consistent with present applicable securities laws. EU's MICA has been fully applicable since December 2024. It's a single regulatory framework for crypto assets across EU member states. The crypto assets that are categorized are as stated on the screen. What issuers need to do, the kind of services that must be licensed, and market conduct regulations, again, here would be quite familiar to everyone in securities and financial services. Interestingly, just 2 months ago, the SEC issued a statement on tokenized securities, consistent with what we've heard so far, right? Tokenization doesn't change the legal status of a security, right? And tokenization concerns the format, not the substance. And so applicable securities laws would continue. The SEC did something quite interesting. It categorized 2 broad categories of tokenized securities. One is issuer-sponsored, one is third-party tokenization, where I think issuer-sponsored is quite clear. We kind of can understand what that means. Third-party tokenization is where a third party creates tokens referencing existing securities. So this could be in the form of assets that it custodizes, or it could be some form of a synthetic tokenization akin to your swaps or derivatives that provide economic exposure without direct ownership. So this will be something quite interesting to look at. So we have organized the main legal structures used to link digital tokens to underlying assets, as shown in these columns. What is the legal structure is very important because it answers the question, when a person holds a token, what legal right does that token actually represent? The first model being the direct model, I think it's quite self-explanatory. Direct ownership of underlying asset on-chain register. The blockchain effectively becomes the authoritative ownership register. Conceptually very straightforward, but it depends really heavily on the existing legal system and the legal framework, whether it recognizes blockchain-based registers as valid ownership records. So for example, our Companies Act, prima facie evidence of title is still the physical share set, right? So when you hear about, oh, I'm tokenized shares, you have to think about what really does that mean, tokenized shares. Questions may also arise about the settlement finality. Okay, so examples would include tokenized bonds that did issue directly on chain. On this, I think SDAX can talk about their experience. And notice that we highlighted tokenized bonds and not tokenized shares, because shares is just more complex. The second model is the indirect model, which serves, I think, the most common structure that we have now in practice. Here, there's no direct ownership of the asset, but the token represents an interest in the intermediary legal entity like the SPV. Okay, so again, this approach relies on well-established legal frameworks such as funds or trust law, right? But it also raises question about custody of the underlying assets and governance of the intermediary entity. The third model, the mirror model, here the blockchain doesn't determine legal ownership, but it mirrors an existing off-chain register. This type of model could provide benefits such as functionality, trading functionality, settlement infrastructure, and transparency. But again, the authoritative legal record remains the traditional register. So the key challenge for this model would be the reconciliation, right, between the blockchain record and the official register, as diversions would really be quite chaotic, quite chaotic. And finally, for what it's worth, scholars have called the fourth model the incomplete model, where the legal link between the token and the underlying asset is unclear or weak. Okay, it may represent a contractual claim, or it may represent just an economic exposure other than contract ownership, right? So we want to avoid the fourth column, needless to say. Life cycle of a tokenized financial asset, as you see in the columns here. So tokenization is definitely not one single event, but a process that spans the entire financial asset life cycle. So the first stage is the asset origination, right, where the underlying asset is created. For example, bonds, fund units. Some of you might have read about the RWA tokenization of a commercial building in Hong Kong, yeah, and IP rights as well. So at this stage, the legal structure is established, whether it's a company, a fund structure, and an SPV. Okay. The second stage on tokenization and issuance is where the asset is, in a way, converted into a digital token. From a legal perspective, the key considerations here would be how the instrument is classified under securities laws. Primary distribution, where tokens are issued or sold to investors. Regulatory considerations here would be investor eligibility, right? Is it only to accredited institutional investors, that sort of thing? Offering documentation and marketing restrictions. Secondary trading, where the tokens are traded on platforms and exchanges. So this introduces regulatory concerns such as the licensing of trading venues, prevention of market manipulation, and ensuring price transparency. Once the tokens have been issued and traded, custody and safeguarding become critical, right? And hence you see that custodians, the so-called wallet providers, now have to be regulated under our laws. I skip over settlement. I think it's quite speaks for itself. And the last column, which is also important, would be asset servicing, which refers to the ongoing life cycle events, right? Like the payment of interest for debt instruments, the payment of dividends, a bit more iffy, redemption and governance rights, right? So overall, the key takeaway is that tokenization affects multiple stages of the asset life cycle, and each stage raises distinct legal, regulatory, and operational considerations. I think for most of us here, we should be quite aware of the taxonomy around digital assets and the classification, right? The boxes highlighted in pink are those that we need to be careful because these are subject to laws relating to offerings and licensing. Okay. Investor protection. We call it, for investor protection, we have classified it into 3 lines of defense in compliance speak. So the first line of defense really lies at the business operations level, okay? And these are the controls and practices that a company must implement in its ordinary course of dealing with investors and operating a tokenized product or platform. So within business operations, there are 3 key aspects. First is core investor protection measures, really identifying the customer suitability, right? Having the controls to monitor fraud and market manipulation, being very clear as to what are the investors' rights, the governance of the issuers and the intermediaries within that ecosystem, and complaints handling. When it comes to custody and safeguarding, I think it goes without saying, safeguarding of the private keys, the wallet security would be key. For regulated entities, you know the MAS has a guideline for you to segregate customers' assets from our own, and so on, operational resilience and cybersecurity. When it comes to safeguarding of private key, conceptually we know it's of course goes without saying, but operationally sometimes it becomes quite hard to really implement. You can implement it for an individual because he holds that seed phrase, he can operate. But what if you're dealing with a corporate? What if it's a corporate handling that wallet? No? Your traditional bank mandates 2 signatory just wouldn't work. So these are the things that we encounter right on a day-to-day basis. The third on disclosure and transparency is that investors must receive clear information. Back in the day, I'm sure a lot of you remember the initial days of the ICOs in 2016, 2017. Were there not many white papers that when we read them, we had no idea what they were saying, right? So actually, clarity on what the business is, what the asset represents, what are the holders' rights are very, very important. The second line of defense, compliance and risk. Very important that the technological innovation does not undermine market integrity or investor protection, right? So the 3 areas here, licensing and regulatory, financial crime, operational, serve to provide that second line of defense. I think the points here are also quite self-explanatory, so I'll just skip them. And then last but not least, you have the importance of internal audit, which all regulated entities have to undergo anyway, right? Where the IA provides that independent assurance. Now, institutional participation, what are some key considerations? For institutional investors such as banks, asset managers, participation is not just about technological readiness. It requires careful assessment, right, across legal, regulatory, operational, and risk management dimensions. For institutional participation, obviously, you need to consider what is the regulatory treatment of that asset, your own investment mandate, whether there are any restrictions, who are the type of customers that are suitable for that product, right? Your own capital and liquidity risk-weighted requirements under applicable laws. I think the second column relates to the first point here. What does the token represent? What rights do the investors have and how would they be enforced? The governing law, rights in insolvency scenario, and so on. When it comes to custody, like I mentioned, who will be the custodian? Is it going to be self-custodized? If it's going to be self-custodized, how? That is really a question that you need to think through. Is the seed phrase going to be put in a safe? Who has access to the safe? It's going to be CCTV monitor and all that sort of thing. It really becomes a project in itself. Okay, and recovery mechanisms for lost keys. Really, there's no recovery mechanism. If you lose your seed phrase, that would be terrible. If we have time after this, I'll share with you what happened to a client of mine. Operational, really reliability of the network. That is quite fundamental. Operational resilience and cybersecurity. So the rest there, I think, would also be quite self-explanatory. Yeah. Can't overemphasize the importance of compliance. A colleague of mine used to say, if you think compliance is expensive, consider non-compliance. For private wealth and high net worth investors are increasingly becoming an important group in tokenized financial markets. Compared to large institutions, they often have greater flexibility in their investment mandates, and they could be early adopters of new financial technologies. However, their participation also requires careful consideration. A lot of this is repetitive in terms of legal and regulatory, in terms of legal structure and ownership, in terms of custody. And I think importantly for private wealth participation would be the tax, estate, and wealth planning. Again, when you think about it, it's quite obvious, but operationally coming to it, it's really not as straightforward as it seems. Okay, we've read of people who lose their key, transfer their key too early, and then the assets are all wiped out. So who has access to that key is a concentration risk. So how do you, in itself, manage that risk, right? And now we hold a lot of things in digital form. Do we actually make plans for all these digital assets of ours? All right, so this is where I move on to my second presentation, and I only have 2 other slides here. So this slide here, I think, can be described as the trust layer. Trust layer for tokenized financial markets. While blockchain technology enables new ways of issuance and so on, large-scale adoption really depends on governance structures that create legal certainty, allows for regulatory oversight and institutional accountability. So you can see the matching of the layers involved in tokenized markets and the kind of governance that's needed. It's a hugely simplified diagram, but I think you get the gist of it. Accountability across the ecosystem. How is accountability distributed? So as mentioned earlier, the market still relies on a network of participants performing roles similar to those in traditional markets. So here we set out the typical roles and responsibilities of the different participants. And the key is this: where there are key duties, there are legal obligations that are captured in regulations and or contract, hence in ensuring accountability. Okay, so, when it comes to issuers, I think the key is investor protection and regulatory compliance, right? And the key duties you can see there. And hence we always tell our clients, whether they are issuers, platform operators, any of these, consult us early, right? We help you manage your your legal risk and put legal certainty right up front, right? For platform operators, market integrity is key, right? So monitoring doing your market surveillance, ensuring operational resilience is critical. When it comes to trustees and custodians, investor confidence, are you going to hold my asset securely, right? So here would be really the risk management around secure private key and wallet infrastructure. Oversight on asset transfers and settlement and so on. Right? For the administrators, the key is in operational accuracy and transparency. If an administrator fails to do a distribution, that's going to create some trouble for the issuer. Yeah, and a lot of things that's happened in the back end, keeping up-to-date records, reconciliation with off-chain registers and so on. The work of an administrator is often unappreciated. I think when it comes to tech providers, it's quite clear. The systems need to work robustly. Last but not least, the advisors, the legal, financial, and compliance. They ensure that structures remain robust and legally compliant, right? So don't speak to us early. The last point on technology alignment. Here we have separated it into 3 columns again. Because the challenge is not simply to adopt new technology, but to ensure that the technological systems are designed and governed in ways that support legal duties. Okay, so I think underlying infrastructure, accountability for your programs, your smart contracts, upgrades, protocols, resilience, technology risk management, it goes without saying. A lot of it goes without saying, in my presentation, it's really in how we operationalize it, yeah. Protection and safeguarding of clients' assets, and transparency, compliance, and authority. So, a lot to digest, but I don't think it's complex. I think it's a lot of it goes without saying. So taken together, these 3 pillars highlight that technology in tokenized markets must align with existing regulatory framework. Okay. And this is really the key takeaway, which I've been talking about. Yeah, I think it speaks for itself. And so I think the closing remark I want to say is that tokenization will succeed not simply because of technology, but because of a trusted ecosystem where technology, regulation, and governance work together. Okay, thank you.
To make it easier, if you have any pressing question, maybe you ask first, and I'll come back to the panelists. Yes, please.
Thank you for your presentation. I'm with Moore Gupta. I'm from a company called FIS. We are a large financial technology firm. So, 2 questions, one for Sunil, one for Kuli. I think on the custodian side, right, because I invest myself in some digital asset. So my always fear is, if in self-custody, I miss the key, everything goes away. So, what do you typically recommend? Self-custodial services or a proper custodial firm managing these digital assets, right? And you are in senior roles in banks and financial institutions. So, how was this personal journey? I really want to know, taking the lead from established to, startup-ish kind of a thing, right? So.
Thanks, Gupta, for your question. Can't answer it one way or the other. because it really depends on the circumstances.
Right.
It also depends on the amount or the value, and it depends on one's own role. Is it my own? Do I intend to leave it for my descendants? Am I holding it as a trustee for someone else? Is it in a retail capacity or a professional capacity? So all these things would have to be factored in the decision making. The thing about self-custody is you have the seed phrase, you save it in your own safe, but then no one knows about it. Then if something happens, how? The assets are totally inaccessible. But if you were to consider, enabling someone to know about, the existence of this seed phrase, then how do you manage the risk? Yeah.
Didn't you mention earlier sharing with the audience your case of your client about lost keys?
It's like a movie. I could not have plotted it better myself. The lost key was what transpired everything, that caused everything to happen and unravel, and that's where the client called me in a very much state of panic. Thankfully, it's their own asset, it's their own tokens. They meaning a corporate. One of their guys somehow went to upgrade the wallet software and somehow lost the seed phrase, okay, and couldn't get access to the wallet. And I don't know why it was, but they said they needed to get in touch with this DAO, this decentralized autonomous organization, that somehow would either mint the new tokens for them or something. I was very skeptical. I went onto the website of this DAO, scroll right to the end, no terms and conditions, no nothing. And ask the client, anything in writing? No, don't have. How are you going to find them? Well, thankfully, they were contactable on Discord. But still no terms and conditions. But I was quite surprised when they responded. And we actually got on a con call with them, amazing, and they turned on their camera. So, I could see, and then they said they're in the Middle East. Oh, okay. And I had to prepare a very thick bundle, an affidavit, so to speak. Not really an affidavit because it didn't go to court, but I had the client swear everything was true before a notary public. Because you're talking about large amounts of money. I think it was about what? US 2 million? It's large to me. And so we did the police report, we did the affidavit, the sworn statement. We submitted the sworn statement to the DAO, the folks that we met on the Zoom call. And this is the other thing about governance protocols. You think, wow, DAO, flatten the hierarchy, democratize, the system, and put power in the hands of the token holders to vote. Sounds all well, nice and good. Then they said, no worries, our community will vote on it this weekend. So then one weekend came, another weekend came, still no votes. Was it apathy? No one wanted to vote, because that's the other thing, you see, when you have that right, you may not always exercise it, and what's to them, why should they vote, right? So there was no decision, and then you know what happened, really like in the movies. The DAO themselves got hacked. So obviously all their attention was focused on saving their own assets and their customers' assets, right? And of course my client's problem became at the end of the list. And it was never resolved, unfortunately. So lost key, that started it off.
So I think it's okay, I just get a feel about the composition of the audience. So maybe how many platforms here? Okay, 2, 3, okay. Okay, how many financial intermediaries, advisors? Okay, right. Okay, how many administrator in terms of custodians? Okay, so it's quite complete. Yeah. So I think if you all ask questions that really that is focused on the latest topic, I think what a lot of you would have gotten out of this this talk here, I think Singapore is actually in the right direction. Right? I think our regulation is getting clearer, adoption is there, backed by MES, right? I think these are all good steps. The reason why I'm here is because I'm a strong advocate of the next step, right? Because I suffered for 5 years trying to get this thing off and all that. So the point really is, I think we are at the cusp of opportunity right now. If all of us get together and believe that we could add on to the ecosystem, I think going forward, real-world asset will be really the bridge or the link to the next big thing. I repeat again, I think real-world asset will be the link or the bridge to the next big thing, because it's only natural, right? Because apart from technology, nothing changes. You've got a trust layer, you've got an enabler. Now it's really whether we all get our acts together and move this to the next level. Yes?
What do you envisage as the next big thing?
Okay, the real-world asset. So in other words, if you look at digital asset,
next big thing?
To tokenize real-world assets, to bring real-world asset into the ecosystem, leveraging on the technology, leveraging on our regulations, and then with all your provision, right, in the ecosystem, this will become a reality. This will become something that will be supported. This will be something that will offer more opportunities for investors, for asset owner, right, and also for the market. So Li Ling alluded a while ago a development in Hong Kong. If you have seen it, it's a listed company that actually set up two funds. One of the funds owned a property in central Hong Kong, and the other fund actually invested in Animoca, right? You all know Animoca, right? Correct? In other words, investments. Both the funds, they then tokenize the funds. Okay, and this listed company then engaged an intermediary to provide the platform and the technology intermediary. And now this stock is called DEL Holding. You can take a look. It's exciting the market. But the big difference I want to add is this. In Singapore, we have the regulatory advantage. But I submit again that we are not exploiting this. You know, in Hong Kong, right? You know the loops that they have to go through? First, they have to go through the 149, upgrade the digital asset. After that, they have to go to SFC to apply, right? To move into the digital space, right? They have to go every step of the way to get it cleared before they could do it. But in Singapore, I think we have enough platform providers. We have the technology, because technology is not new, right? We have very good regulators. Ms. Chang was a former regulator. You know, I think the rules are clear, the securities rules are clear. We have a strong enough financial market. So I think the time is right. So actually, I just want to say this word. I came here for a purpose, which is to make this statement. The time is right for real-world asset tokenization. The other area which I think will be real will be IP tokenization, followed by shares tokenization. In other words, what I'm saying is that shares listed on the stock market can be tokenized. And with that, it can be offered worldwide. You know, imagine the speed, the crowd, right, and the reach. This is what technology offers us. Yeah.
Thank you for the presentation. And our company has done some cases for tokenization already. The private equity you just mentioned, company shares, and also property tokenization, we all done. I think the biggest difficulty here is not like the technology, it's the distribution channel. Like the liquidity is actually the biggest problem. We can do the tokenization, we have the custodian license. The biggest thing is will buy it? That's what I want to ask.
So I think this question will be best posed to Sunil, because I think SDAX went through that phase where they had to find a distribution for their products. I think last year SDAX crossed $1 billion, right, in terms of.
That's right, Chang. I think the point that we have, that was in one of the slides, is secondary market trading, right? Most of, in our experience, so I can only speak for our experience. In our experience, as I said probably earlier in the conversation, a couple of things that investors are looking for: duration, so tenor, yield. Most of the type of accredited investors we're dealing with are just buying to hold. So basically, they want a tenor, they want to be paid out a certain coupon at the end of the year, or 6 months, or 2 years, or whatever. So what we are struggling, and by the way, I've been in many of these other forums, everybody else is, we've got some of my colleagues here in other industries holding the same role, and they will no doubt confirm that. Secondary market liquidity, people, we're not yet having, we got to, as a group, as a collective, work out how we can start building that. So one, I guess Chang was just talking about carbon trading. So one area is, can we start looking at secondary markets in carbon trading? There is, I mean, most of the countries now are carbon short, Singapore included. So can they buy carbon credits now from carbon long? So we've got countries in the region like Bhutan, which has got long inventory in carbon. So can we create? So there are platforms that enable that. So that is one way to look at how you can create. So we need together to come up with a solution to how do we encourage the secondary market trade. So there could be, because it requires a little bit of speculation there, right? You have a secondary market in anything where people want to take a position on. If you're starting with the premise that I just want to buy to hold, there'll never be a secondary market. So I see where you're coming from, and we are, by the way, in conversation with our affiliated entities, the custodians, etc. If you were to go down that route, or for example, technology platforms that currently provided, how can I plumb the pipes so that these pipes can seamlessly flow through, so you come in and then the issuer can do secondary if they want to. And we're working on that conversation. So there's a dialogue right now, but it is a constraint right now, and it's an industry issue. And by the way, I can tell you, because in some of these forums, they're not just an Asia problem. This is everywhere. The only area where perhaps, and some of you may know better about this, where we're seeing a little more secondary market activity happening is probably in the US with all the push that's coming out of the Genesis Act, which has been quickly embraced, obviously, because leadership right at the top is pushing that agenda. So there is a little more activity we're seeing there, and perhaps we can all see and leverage of what they're doing to encourage that.
So maybe if I can add to that, right? Basically, I see it as a demand and a supply issue. So if more good products come onto the table that leverages on the technology, right? So you create the demand, right? So good yield, good return, good assets is where you build this community. So I think SDAX has got a product, go and take a look. It's actually the gold notes, right? I think for the longest time, for the last 2 years, it has done very well. Good interest rate, and then amidst the volatile situation, it's a hot investment product for investors. That's one example. The next example that you could look at, right, are also some very interesting bio-assets. Some bio-assets are really interesting. But I do not know whether you know olive trees, right, can actually live for, I think, 1,000 or 2,000 years, right? So when you invest in an olive tree, if you have the technology, digital blockchain to trace, to know that that's your asset and what it produces adds to you, an extra seed that you grow is your bonus shares, things like that. It's a very good investment product, right? Because, well, who can live 1,000 years, right? So you can see that, yeah, it's just whether the market will actually come forth, right? And when it does, I think it'll be very interesting. Yeah, sorry, sir.
Hi, thank you for the opportunity. I'm Shubham. I'm the founder of a company called Swords. We majorly build tokenized infrastructure and bring it into business use cases for large financial institutions. Interestingly, we are also in the sandbox in India for tokenization of shares, where there is questions of dividends and ownership rights. One of the questions I had regarding this, and I had a specific vector around it. One of the things that when we are approaching large banks, financial institutions, although the regulatory aspect is fine and let's say the technology aspect is fine, what they're really looking at whether you can enable a newer business use case, whether you can immediately do immediate gratification around it. A lot of time institutions are not looking for larger efficiency-based settlement times or just 24/7 settlement enablement. They're looking for how the moment I basically run a real-world tokenized asset product, how I can actually make more, or does it open up new access to new clients? So that's where I think one bigger part that has been missing from the asset tokenization space is actually been newer business cases or newer models that get facilitated with this new technology, rather than just replicating or mirroring whatever instrument that we have. So this is where also there's some innovation happening in trade finance, TPA supply chain finance also. So there are newer products also kind of getting developed, which these banks are able to actually have impact on their yield directly, but within the regulated asset spaces. So any ideas around any thoughts around it, where like newer models or newer asset forms or asset classes coming up?
So I agree with that lady at the back, that secondary market is quite tough. I think the government recognized that as well. And I think it's tough because if you structure something as a financial product, as an investment product, really your pool would be limited, because otherwise there are prospectus requirements and you only can follow the prospectus exemption class.
No money, who is deep pocketed, right? So we grouped them all together and said, okay, let me do this commercial paper for you. And I do it digital because I want to save on the cost, right? And the rest is history today. So the point really is, when there's need, all right, and innovation, it will happen. But technology must keep up the speed. So I like what you say that you're doing share tokenization. It's something that we are also doing. So I think we may have to learn from you how to do it properly, you know? So maybe we'll exchange notes. So that's my answer to your question, yeah.
So I hear that tokenization brings about operational efficiency. It's a layer that makes everything work for everybody involved in the ecosystem. But it can only be adopted by institutional investors or institutions if it offers the same level of governance, investor protections, etc. However, it gets a little bit more nuanced because of the whole tokenization layer exposes us to additional risk. My question is, because we have to put in the steps to address all of these, what are the operational efficiency that's left? Other than fractionalization, because we can only deal with AI and II, fractionalization is not, a key concern of theirs.
I love the question. It's a very PhD question, actually. We let the PhD lady.
Actually, the use of smart contracts has been talked about to automate a lot of processes, right? And I think that will bring about quite a lot of efficiency. But of course, a lot of testing and audits to make sure that these smart contracts really work the way they do, and they don't distribute the dividends to wrong people, etc. I think that work still needs to be done to ensure that institutions are confident that it will work as promised. And that, of course, will mean that a lot of operational teams will lose their job. Because, right now, you have teams for processing dividends, interest payments, etc. Right? If they miss it, it's late. Smart contracts make sure it's paid out on time, but, of course, that has to be tested.
I agree with Ching. You see it in a lot of the streamlining of processes that are very manual, and now you see it taken over automated, right? Like the automatic payment of coupons into your wallet. There are even blockchain systems for voting. So it takes away a lot of the admin inefficiencies that we associate with traditional markets. If
I may add, when you add on AI, agentic AI, I think it will be quite frictionless.
Sorry, I thought I might try and add to. So my background is a bit like Sunil, except I was in structured products at the big banks, and then I was head of an exchange similar to SDAX. I know the predecessors, but we also have the license to do custody. So a lot of the efficiencies come from the fractionalization also of the product. In structured products in the traditional markets, you have very big quantums, and the counterparties are very expensive. This, without doing the word democratizes, brings the access of tokenized assets in security format, so it's protected, safeguarding investors to a larger pool of accredited investors. And the efficiency is in packaging it into a tokenized format. In the traditional world, securitization is hundreds of millions of dollars. This is not possible. So there in itself is already efficiencies, and the legal fees are a lot less, right? Maybe the wrong audience, but there are a lot of efficiencies. Secondary market, I came to Singapore to do that, but it's very, very difficult with AI and above. There's not enough volume.
That's exactly correct.
I was just going to make a comment that, you think about tokenization, about operational efficiency, but it goes beyond that. It actually unlocks value. Just to give an example, when NVIDIA shares was EBS or IG markets is useless in DeFi. I can't use it as collateral in Asta or Hyperliquid. My tokenized NVIDIA, on the other hand, of X stock and stuff like that, I can use that as collateral. It's valuable. So actually, tokenization goes a lot further than operational efficiency. It actually unlocks the value, and it allows you to do a lot more.
Because your question wasn't about unlocking value, but I think it's a very good point. Excellent point. So the gold notes that we did, right, is really unlocking value. So what we have is gold from refinery, right, sitting in the vault in Middle East. Can't do much, right? But the moment we can tokenize it, put it in the vault here, right, and then it gives that extra collateral value, security value, and So the point is it's totally real. Today for IP, for example, you do not need the IP to be commercialized. The moment IP itself is good enough, you can take a bet. You can actually take a bet through tokens, and if it flies, you make it. So I think that's really what it is. Sorry, cannot answer your question, so pretend a bit answer the other question. But seriously, yeah. Okay, yeah.
If real-world tokenization is really the next big thing, what do you think are the chances of the big corporate banks getting there first and sort of capturing that space compared to smaller players being able to use this sort of technology change to create a little space for themselves?
So you're going to take this?
Yeah, so I think there are two challenges, right? For the big banks, there's balance sheet challenge. So typically, they can only lend or finance above a certain category as credit getting tighter. And I've got just a colleague of ex-banker in the room who concur or otherwise. Jump
No,
in.
different risk appetite.
Correct. Completely different risk appetite as well. So the reality is, and time to market. I guess there are two things, right? In a big bank, you've got, and we've had our careers in them, layers of approvals, layers of authorizations that are required before you can even get your act together. So I think in terms of, from my perspective, where we come from, just the time to market of the whole transaction is quicker. The due diligence is still got to be the same, obviously. The difference is you've not got huge hundreds of credit risk officers looking at it, you got a smaller team, but you still got to do due diligence because ultimately, as we've all acknowledged, investor protection is key. Making sure they understand the securitization vehicles, etc., where this collateral is held, as we've said in the numerous examples, including the one Chang referenced in Hong Kong on the commercial property. It's very important that people understand, which is why it's limited to AIs and institutional investors, because otherwise it's just from where we sit, it's very high risk if a retail investor says later they would understand the product, right? It's not easy. But from a bank's perspective, I guess those are the challenges they face, and that's why for them sometimes it becomes faster for us to work. Why do, I guess the other example that was used, why would a big listco, for example, come to a smaller provider to raise finance? Again, some of the same reasons. More efficient in that faster. And also sometimes if you're you're sitting as a listco, raising finance can send wrong messages to the market, right? I mean, sometimes they just want, it's not an indication of raising finance, not because necessarily there's any element of distress or anything. So I think from that perspective, they don't necessarily, and these amounts are small, right? We can't, I guess to your other question, we can't do a type of loan that a corporate bank could do. 100 million, for example, for any of the institutions we worked in before, that's normal. Very bog standard, normal. When you're talking above $1 billion or 500 and above, that is really where you get, but our quantums will always lower. So if you're looking to raise small amounts without sending mixed messaging to the markets, without sending the wrong signals, etc., then this is an option. And in a reasonably quick, fast turnaround, I think then that's some of the reasons. Sorry, anybody in the panel can just see if there's a different perspective. Or
Cost of capital
cost of capital.
improves the valuation of the corporate.
Gentlemen,
Absolutely. With respect to the Iran and US war now, the crude oil become a hottest commodity in the market. So my question is, how do we strike a fine balance between tokenize this immensely volatile asset and maintaining a proper risk management framework?
So sorry, you could elaborate the question again. So,
No,
so in relation to Iran, the war,
Yeah.
it's about the oil.
Oil, yeah.
Okay.
So we're going to tokenize
Yeah.
immensely volatile asset like crude oil, yeah, or other oils. So there always is the upside is a lot. There's a 10% up and down on the market, but one day or the other will become 10%. How we can tokenize this hugely, immensely volatile assets and also maintain the risk management framework in these tokenized products?
Maybe should be able to answer. So it's basically
Can I help?
Yeah, you can. Yeah.
So traditionally you hedge it with oil futures.
Yeah.
So in this case, you package it in a format and then tokenize it as a package in a dynamic risk model. Perhaps use Black-Scholes options pricing. I've done that before. But anyway, it's got to be dynamic hedging and it's got to be packaged. The thing about tokenization is that you can reduce the size and you can action it a lot quicker. Potentially, depending on the family of law. That was one question I had for Li-Ling, whether civil law applies also, because you talked a lot about common law. Civil law is slightly different. And then you have Islamic law. Yeah.
Yes.
So maybe I can just answer your question, right? So this is not something that tokenization cannot do. So anything in the traditional market, right? We tokenization is just a technology, right? The only difference is that it's the regulation of the country. So in Singapore, for example, our regulators are very strict. For what we do mostly in the asset space, the payment space, is all heavily regulated, right? So to the extent where they feel like we are not ready, we don't let you have the ability to go and deal with this kind of products, right? But this is, I believe the product you mentioned is readily available in the States. Yeah.
Could I just give an example? It's not oil, okay, but just you can see it as an analogy. A couple of years ago, my partner Amanda and I, we got this query from a client who apparently owns a whole museum of art. It was the artwork of a romantic painter, I can't remember what's his name. But apparently, climate controlled museum with all the art pieces. He says, I want to tokenize all my art pieces. Then we had to ask him, what do you mean you want to tokenize your art piece? If the token is to represent the painting, is it just an image? Or are you really tokenizing the artwork so that the token represents ownership of the artwork? It's really interesting because I raised this because artwork is not a financial product, hence not subject to the regulations that we've been talking about. And his question was, no, I don't want to sell ownership. But he wants to sell tokens based on the value of his paintings, but he doesn't want to part with ownership. You see, so when it comes to structuring of products, it's very clear we need to know what exactly is the underlying. For gold, for oil, someone has to own the oil, right? And if we want to tokenize it, what does it mean? Does the token represent, say, a whole barrel that's sitting somewhere? Okay, then it comes under commodity trading laws and regulations for which there are also restrictions. So once a token becomes a financial or investment product, there would be a lot of these restrictions and regulations. Quite unlike real world physical products like an artwork. Actually can talk quite a lot more about this. We can talk about it later.
Yeah, I think just to your other point, very highly volatile assets like oil that you just described. Now forget the war, but even otherwise, the war makes it even more. The risk management has to be real time and has to be active, and small players don't have that ability to risk manage like that. It's only the large banks who may have oil desks, and don't forget, even a lot of the banks exited commodity trading because of this. Because today the risk in today's market is just off the charts. But smaller players, or it would be very difficult. And the point that was made here correctly is the legal rights. Is it the barrel? Is it the refinery? Is it the country that owns it? So there are several challenges. That's probably why it's not immediately, other than perhaps the Chang was saying, maybe in the US that might be something they're looking at in the tokenization space. Not as yet. We'd rather stick to underlying assets which have stability, and many of the things I talked about, those characteristics I talked about, that's important. Particularly more so, I think, in nascent markets, which are still growing and evolving. This could be a different conversation in 5 years' time or whatever, but as things are today.
That's right, yeah. So today is, more packed to underlying assets. Yeah. Okay, I think we have really, went in depth to that question. Are there any other questions that you want? Yeah.
Just a quick question on potential legal suits. What kind of legal suit that can arise, considering that the ecosystem involves quite a lot of players, for example, insurers, operators, trustees, industry, even advisors. Maybe just a snapshot of the kind of things that can go wrong as a result of this.
So the entire ecosystem that I've shared just now, you just do all the permutations. Yeah, so potential for legal suits abound in all those various permutations. From the tokenized exchange, where supposed to hold clients' money in a segregated account, when clients came to redeem, no money. Obviously, why not segregated, mingled with the platform's own assets? So that's an ongoing complaint to our regulator. Many.
Chang.
No, I just, I know we have a lot of questions, but we sort of been told by the event venue that we are running out of time. So maybe if we could adjourn for some networking, snacks, and then we could talk while we're eating. Right, thank you.
Yeah, well, thank you for your questions.
Thank you.
Thank you so much.
Well, we keep on